I promised myself early in my career that I would never become another Wall Street cautionary tale. Yet here I am, Jesse Livermore, once worth the equivalent of $1.5 billion in today's money, later taking my own life in a hotel cloakroom after losing it all. My rise and fall contains lessons more valuable than any trading strategy I ever developed. I made and lost 4 fortunes in my lifetime. The market gave, and the market took away. In 1907, I made $3 million shorting the market during the panic. That's over $80 million today. In 1929, I profited $100 million from the greatest crash in history, while others jumped from windows. Yet by 1934, I'd lost it all again. My final bankruptcy filing showed just $17,000 in assets against $2.5 million in debts. The irony cuts deep. I wrote a best-selling book called How to Trade in Stocks, yet couldn't follow my own rules consistently. I developed trading principles still taught today, yet my emotional demons ultimately destroyed me. Let me share what I learned about success and failure in this merciless game. My first principle: the market is never wrong. Opinions often are. When I traded against the tape, against what prices were actually doing rather than what I thought they should do, I always lost. The market doesn't care about your convictions or your cost basis. Price action tells the truth while our minds create fictions. In 1908, I nearly went broke fighting the market's upward momentum because I was convinced stocks were overvalued. My opinion cost me millions. The market was right. I was wrong. Learn from my mistake. My second principle: cut your losses quickly. This single rule would have saved my fortune multiple times. My greatest weakness was my inability to accept small losses. I'd average down, double my position, fight the market, anything to avoid admitting I was wrong. When cotton crashed in 1919, I refused to accept a small loss until it became catastrophic. My third principle: let your winners run. In 1907, I held my shorts as the market collapsed day after day. I didn't get impatient. I didn't take quick profits. I rode the trend to its conclusion and made millions. Most traders do the opposite. They cut winners short and let losers run, ensuring mediocrity or failure. However, my tragic flaw was psychological. Despite knowing these principles intellectually, I couldn't consistently apply them emotionally. The market reveals your character flaws with brutal efficiency. My need to be right, my addiction to action, my inability to follow my own rules, these destroyed me financially and ultimately as a human being. The greatest lesson from my life isn't about technical analysis or market timing. It's about the psychology of trading. Develop rules that work, then have the discipline to follow them religiously. The market will test your emotional resilience more than your intellectual capacity. Remember this: success in trading isn't about being smarter than others. It's about being more disciplined, more patient, and more honest with yourself than others. I knew how to make money. What I failed to master was myself. Let me tell you about the 2 fatal mistakes that nearly destroyed me several times throughout my career. The first was ignoring my own trading rules. The second was overtrading. These twin demons cost me millions and repeatedly drove me to financial ruin. When I developed my trading system in the early 1900s, I created specific rules after painful lessons in the market. One of my cardinal principles was to never act on tips or hunches. Yet in 1907, despite my own wisdom, I listened to a sure thing about Union Pacific from a trusted friend. I violated my core rule against acting on tips and lost $40,000 in a single day. The market taught me an expensive lesson I had already learned before. I've made and lost several fortunes throughout my career precisely because I would establish disciplined systems during successful periods, then abandon them during emotional moments. In 1929, my rules told me to go short before the crash. I made $100 million in today's dollars by following my system. But by 1934, I had lost it all because I started making impulsive trades outside my methodology. Your trading rules are your armor in battle. When you remove that armor, the market will wound you. I've watched countless traders develop sound strategies only to abandon them at the first sign of difficulty. This is suicide in the markets. The second fatal mistake, overtrading, is equally destructive. I define overtrading as taking positions that are too large or trading too frequently. In 1908, after rebuilding my capital, I became overconfident and began taking excessive positions. My account couldn't withstand normal market fluctuations because my size was inappropriate for my capital base. During the panic of 1907, I correctly identified the market direction, but traded so aggressively that when J.P. Morgan orchestrated a temporary market rally, my over-leveraged positions were wiped out. Had I traded proper size, I could have weathered the counter-trend move and profited enormously from the continued decline. Overtrading also manifests as excessive frequency. The market doesn't present ideal opportunities every day. Yet I would force trades during quiet periods out of boredom or impatience. These unnecessary positions inevitably lost money. I discovered that my most profitable trades came from patience, waiting for perfect setups where multiple factors aligned. In 1924, I waited 6 months for the perfect cotton trade. My patience was rewarded with a $2 million profit on a clear trend that I rode without interruption. Remember this, the market will always be there. Missing an opportunity costs nothing. Making a poor trade costs capital. Your trading account is your business inventory. Protect it as fiercely as a shopkeeper guards his merchandise. These two mistakes, ignoring my own rules and overtrading, repeatedly destroyed my wealth. Learn from my failures. When you establish rules, follow them religiously. When sizing positions, err on the side of caution. The consistent application of sound principles, not occasional brilliance, creates lasting wealth in the markets. The third fatal mistake that destroyed my fortune twice is poor position sizing. I've seen countless traders with brilliant analysis fail because they bet too much on a single trade. In 1908, I had correctly predicted a market crash and positioned myself short. My analysis was perfect, but my execution was flawed. I sized the position too aggressively. When the market initially moved against me, I faced a margin call that forced me to close positions prematurely. Just days later, the crash I predicted happened, but I wasn't there to profit. A potential $1 million gain turned into a $50,000 loss. Let me be crystal clear. No matter how confident you are in a trade, never risk more than 2% of your capital on a single position. I learned this rule through devastating losses. During the 1929 crash, I made $100 million because I sized my positions appropriately, large enough to matter, but not so large that temporary adverse moves would wipe me out. I could withstand the volatility because no single position could destroy me. Position sizing isn't about how much you can make. It's about how much you can afford to lose. The market doesn't reward greed. It punishes it mercilessly. I've watched brilliant traders go bankrupt because they couldn't grasp this simple principle. They'd risk 20% of their capital on a sure thing, only to watch it evaporate in minutes. The fourth fatal mistake, perhaps the most insidious, is revenge trading. This destroyed me in 1915 when I lost my second fortune. After taking a significant loss, I immediately jumped back in, trying to get my money back. This emotional reaction led to a cascade of increasingly desperate trades, each worse than the last. Within months, I'd lost nearly everything. When you take a loss, your judgment becomes clouded by emotion. Your brain isn't processing market information. It's processing pain, anger, and fear. I've learned to step away from the market completely after any significant loss. I don't return until my emotional state has normalized, which sometimes takes days or even weeks. In 1929, I avoided revenge trading by implementing a strict rule. After any loss exceeding 5% of my capital, I would not initiate new positions for at least 3 trading days. This forced cooling off period saved me millions. While others frantically tried to recover losses during volatile market swings, I observed calmly from the sidelines, re-entering only when I had clear thinking and a defined edge. Remember this: the market will always be there tomorrow. There's no trade so good that it can't wait until your judgment is clear. I've made far more money by the trades I chose not to make than by the ones I did. These 2 mistakes, poor position, sizing, and revenge trading, are fundamentally about psychology, not strategy. They reveal a lack of emotional discipline, not analytical ability. Master your emotions, and you've mastered the hardest part of trading. Fail to master them, and no system, no matter how brilliant, will save you from eventual ruin. I've always told traders that the market will break you before it makes you. My own breaking point came not once, but several times throughout my career. These dark hours taught me more about trading psychology than any profitable streak ever could. Let me share what I learned in my darkest moments, so you can avoid the same devastating mistakes. The most crushing blow came in 1929. I had correctly anticipated the market crash and positioned myself to profit enormously. My net worth swelled to over $100 million in today's currency. I was at the absolute pinnacle of trading success. Then I did something inexcusable. I abandoned my own system. I started listening to outside opinions, reading newspaper headlines, and letting emotion drive my decisions. Within months, I lost everything. Not just money, but my identity, my confidence, and nearly my will to live. I remember sitting alone in my hotel room, staring at the wall for hours, contemplating whether life was worth continuing. The market had broken me completely. What I didn't realize then, what took me years to understand, was that this breaking point contained the most valuable lesson of my career. No trader is immune to psychological destruction. Not me, not you, not anyone. The market doesn't care about your past successes. It doesn't respect your reputation or your bank account. It will take everything from you the moment you violate sound trading principles. I learned this through crushing personal experience. My system had always been built on emotional detachment. I would identify trends, ride them patiently, and exit when my indicators signaled a reversal, never based on hope, fear, or external opinions. But success itself became my downfall. I grew arrogant. I started believing I could outthink the market rather than simply following it. When you reach that level of overconfidence, the market has a way of humbling you with brutal efficiency. It took me 3 complete cycles of building fortunes and losing them before this lesson fully penetrated my consciousness. Here's what I want you to understand. Your breaking point will come. The market will find your psychological weakness and exploit it mercilessly. It might be fear of missing out, inability to take losses, revenge trading, or in my case, the hubris that comes with success. The difference between traders who survive long-term and those who don't isn't about avoiding these breaking points. It's about how you respond to them. I rebuilt my fortune multiple times because I used each failure to strengthen my trading rules and psychological discipline. After each collapse, I returned to the core principles that had made me successful initially. Trade with the trend, cut losses quickly, let profits run, maintain position size and discipline, and above all, control your emotions. Your breaking point, when it comes, will reveal your true weakness as a trader. Pay attention to that revelation. It contains the key to your eventual success. In my case, I had to learn, painfully, that no amount of success justifies abandoning a proven system. The market will always have the last word. The market taught me the harshest lesson about over-leverage in 1907, a lesson that cost me my first fortune. When I tell traders about this mistake, they nod as if they understand, but then make the exact same error. Let me be crystal clear. Over-leverage doesn't just reduce your profits. It destroys everything you've built. I had accumulated nearly $1 million by 1907 through disciplined trading. My success came from following my system meticulously, waiting for the perfect setup, entering at precisely the right moment, and letting profits run. But I made a fatal error that would haunt me for years. I bet too much on a single position. The 1907 financial crisis presented what I thought was the opportunity of a lifetime. The market was crashing, banks were failing, and panic was spreading like wildfire. My analysis told me stocks would fall further, and I was right. Dead right. But being right isn't enough when you're over-leveraged. I shorted Union Pacific with nearly everything I had. The position was so large that even small price movements would dramatically impact my account. When the stock plummeted as predicted, my profits soared. This early success reinforced my dangerous overconfidence. What I failed to consider was the possibility of intervention. J.P. Morgan and other bankers stepped in to stabilize the market. When they did, stocks rebounded violently. My massive short position turned against me with brutal speed. Because I was over-leveraged, I couldn't withstand even a temporary reversal. Within days, my entire fortune was wiped out. $1 million, gone. Not because my analysis was wrong, but because my position sizing was catastrophically flawed. The market was doing exactly what it was supposed to do, move unpredictably. I was the one who had violated my own rules. Here's what I learned. Your first priority isn't being right, it's surviving. When you over-leverage, you surrender control to the market. A 10% position that goes against you is manageable. A 50% position that goes against you is terminal. My rule after this disaster became ironclad. Never risk more than 10% of your capital on a single trade, no matter how certain you feel. And never allow a single loss to exceed 2% of your total capital. These aren't arbitrary numbers. They're survival thresholds I paid $1 million to learn. The professionals who survive decades in this business understand something the amateurs don't. Position sizing is more important than entry points. The best trade with poor position sizing will destroy you. An average trade with excellent position sizing will keep you in the game. When you feel absolutely certain about a trade, that's precisely when you should reduce your position size. Certainty is a warning sign of emotional involvement. The market doesn't reward your conviction. It punishes your arrogance. I lost everything in 1907, but that loss gave me the foundation for future success. I rebuilt my fortune with a newfound respect for risk management. The trader who survives is a trader who lives to trade another day. Remember, the market will always be there. Your capital might not be if you over-leverage. I made my fortune following a system I meticulously developed over decades. Yet the most valuable lesson I can teach you comes from when I abandoned my own rules and paid dearly for it. In 1929, I made $100 million shorting the market crash. By 1934, I'd lost it all. Why? Because I violated my own trading principles. Let me be brutally honest about my greatest failure. After my spectacular success during the 1929 crash, I began believing I was infallible. The market had validated my genius, or so I thought. This is precisely when the market purports to teach you humility. My system had clear rules: never average down on losing positions, cut losses quickly, and never fight the primary trend. These principles had made me millions. Yet in the early 1930s, I began ignoring these very rules. I averaged down on losing positions, hoping they would recover. I held on to losses, convincing myself the market would eventually prove me right. I fought the trend instead of following it. The result was catastrophic. By 1934, my $100 million fortune had evaporated. It wasn't market conditions that destroyed me. It was my own psychological weakness. I abandoned discipline exactly when I needed it most. Here's what I learned from this devastating experience. Success can be more dangerous than failure. When you're winning, overconfidence creeps in. You start believing you're smarter than the market. You begin taking shortcuts. You make exceptions to your rules. This is precisely when destruction begins. The market doesn't care about your past successes. It doesn't reward you for previous brilliance. It only responds to your current actions. When I abandoned my system, the market punished me swiftly and mercilessly. My greatest regret wasn't losing the money. It was betraying my own hard-earned wisdom. I had spent decades developing rules that worked. Then, at the height of my success, I convinced myself those rules no longer applied to me. What arrogance! What folly! This is why I tell you now. Your trading system is only as good as your discipline in following it. The moment you make exceptions is the moment you invite disaster. I know this truth not from books or theories, but from the crushing weight of a $100 million lesson. Even more painful was the realization that I knew better. Each time I violated my rules, a voice inside warned me of the danger. I silenced that voice with rationalizations. I told myself this time was different. It never is. If you remember nothing else from my life, remember this. The rules that build your success are the same rules that preserve it. Abandon them at your peril. No trader, no matter how brilliant or successful, can outsmart the market's fundamental principles. My legacy isn't just the fortunes I made, but the fortune I lost by forgetting what made me successful in the first place. Discipline isn't just one aspect of trading, it is trading. Without it, you're merely gambling, regardless of how sophisticated your system might be. The psychological battle of trading is where most lose the war. I learned this lesson the hard way in 1929. While I made $100 million shorting the crash, my greatest defeats came not from faulty analysis, but from psychological warfare, both from the market and from within my own mind. In 1929, I executed one of the most profitable trades in history. I recognized the market euphoria for what it was, a bubble ready to burst. I shorted heavily, positioned myself against the crowd, and made a fortune when it all came crashing down. My analysis was perfect, but what happened next reveals why psychology, not analysis, determines ultimate success. After my triumph, I fell victim to my own success. I began to believe I was infallible. This psychological trap is deadlier than any market move. When you start believing you've mastered the market, you've already lost. I became overconfident, taking positions based on my reputation rather than my discipline. By 1934, I'd lost most of my fortune. Market sentiment hadn't defeated my analysis. It had defeated my psychology. I allowed public perception of my genius to inflate my ego. When sentiment shifted against my positions, I refused to adapt. I couldn't accept being wrong after being so spectacularly right. Here's what I learned about psychological warfare in the markets. First, recognize that market sentiment is designed to make you uncomfortable. When you feel most certain, that's when you should question yourself most rigorously. I failed to do this after my 1929 success. Second, understand that the market doesn't reward intelligence. It rewards psychological discipline. Some of the smartest traders I knew blew up their accounts because they couldn't control their emotions. I was brilliant at reading markets, but failed at reading myself. Third, develop systems to protect yourself from yourself. After my downfall, I created strict rules about position sizing and stop losses. These weren't to protect me from the market. They were to protect me from my own psychology. The most dangerous market sentiment isn't bullishness or bearishness. It's the sentiment that develops in your own mind. When you're winning, you feel invincible. When you're losing, you feel the market is personally targeting you. Both are delusions that will destroy you. I eventually took my own life in 1940, not because I couldn't understand markets, but because I couldn't reconcile my understanding with my psychological weaknesses. My story isn't meant to depress you, but to warn you. Master your psychology before you attempt to master the markets. The greatest edge in trading isn't a superior strategy. It's superior psychological discipline. I could teach anyone my market timing techniques in a week, but the psychological fortitude to execute them consistently, that takes years of deliberate practice and painful lessons. Remember, market sentiment doesn't just move prices, it moves minds. Guard yours vigilantly. The Phoenix strategy is what I developed after my most devastating losses. When you've been wiped out completely, not once, but multiple times as I have, you either develop a framework for rising from the ashes or you perish permanently. My recovery framework isn't just about recouping financial losses. It's about rebuilding your psychological capital. After my 1908 cotton market disaster, I lost everything. Then again in 1915, and most famously in 1929. Each time I had to reconstruct not just my account, but my entire approach to markets. This framework is what allowed me to come back and amass fortunes repeatedly. First principle of the Phoenix: start with absolute honesty about what went wrong. I never blame the market. After my cotton disaster, I spent weeks analyzing my trading journal. I discovered I'd violated my own rules about cutting losses. The market didn't destroy me. I destroyed myself by abandoning discipline. Your recovery begins with this brutal self-assessment. Second principle: reduce position sizes dramatically. When I returned after my 1915 wipeout, I traded at 10% of my previous size. This accomplished two critical things. It preserved my remaining capital during inevitable mistakes, and it reduced the psychological pressure that leads to poor decisions. I've observed that most traders who attempt comebacks fail because they try to recover everything immediately with oversized bets. Third principle: return to your proven methodology with religious devotion. After each failure, I returned to the core principles that originally made me successful: following price action, cutting losses quickly, and letting profits run. The temptation after a devastating loss is to seek a new, magical system. This is precisely wrong. Innovation comes from strength, not desperation. Fourth principle: rebuild mental capital through small victories. After my 1929 wipeout, I focused on making a series of small, correct trades rather than home runs. Each successful trade, regardless of size, restored my confidence. Mental capital compounds faster than financial capital, and without it, no strategy works. Fifth principle: study the environment that destroyed you. After the 1929 crash, I spent months analyzing what happened. I recognized that market conditions had fundamentally changed, requiring adaptation while maintaining core principles. The greatest recoveries come when you understand both timeless truths and changing environments. The Phoenix strategy isn't merely about financial recovery. It's about becoming anti-fragile. I've emerged stronger after each destruction because I used these principles to transform devastation into wisdom. When you've lost everything, you gain the rare opportunity to rebuild without the accumulated bad habits that led to your downfall. Remember this: the market will test you repeatedly, often to destruction. Your capacity to rise from these tests, maintaining both your capital and your sanity, is what separates legendary traders from forgotten ones. Leverage is like morphine. The first time you use it, the high is incredible. It amplifies everything: your gains, your confidence, your sense of invincibility. But what I learned through blood and tears is that leverage doesn't just amplify your gains. It magnifies your mistakes until they become fatal. I call it the pyramid of leverage, and it nearly destroyed me multiple times. In 1908, I pyramided my positions in cotton to such an extreme that when the market turned against me, I lost everything. Not just my profits, everything. The same pattern repeated in 1915. I would start with a reasonable position, see it move in my direction, then add more, then even more, building a pyramid of positions, each one larger than the last. The mathematics of leverage are deceptively simple. A 5-1 leverage means a 20% move against you wipes out your capital. At 10-1 leverage, just a 10% adverse move destroys you. I watched countless talented traders build these pyramids of leverage until they couldn't sustain their own weight. What makes leverage so seductive and so deadly is that it works brilliantly until it doesn't. When I was right and pyramiding my positions, the wealth accumulated at a staggering rate. In 1907, I made $3 million in a single day shorting the market. That kind of success creates a dangerous illusion of control. I developed 3 rules about leverage that saved me from permanent ruin. First, never add to a losing position. Ever. The market is telling you something important when it moves against you. Adding more leverage to a mistake compounds that mistake exponentially. I violated this rule repeatedly in my early career and paid dearly each time. Second, reduce leverage as your account grows. When I had $10,000, I needed leverage to build capital. When I had $1 million, that same leverage became unnecessary risk. The greatest traders I knew understood that preservation of capital eventually becomes more important than growth. Third, calculate your maximum loss before applying leverage. If a 5% market move would wipe out 30% of your capital, your leverage is too high. I learned to work backward, determine what loss I could tolerate, then size my leverage accordingly. The most insidious aspect of leverage is psychological. It creates an addiction to action, the need to always be in the market, always making big bets. During my darkest periods, I couldn't sit still. I couldn't wait. I couldn't stay in cash even when there were no clear opportunities. In 1929, before the crash, I reduced my leverage dramatically because the risk patterns had changed. That decision preserved millions. The traders who maintained their pyramids of leverage during that crash didn't just lose money. Many lost their lives to suicide. Remember this: the market will provide plenty of opportunities throughout your lifetime. Excessive leverage forces you to swing at every pitch, while patience allows you to wait for the perfect pitch. I've made my greatest fortunes not from how much leverage I applied, but from how patiently I waited for the ideal conditions before applying any leverage at all. I've always said that the market is never wrong, but I've had to learn this lesson repeatedly throughout my career, sometimes at devastating cost. One of my most painful lessons came from being stubborn, fighting what the market was clearly telling me, and paying a catastrophic price for my arrogance. In 1929, I made one of my greatest trades by shorting the market before the crash. I walked away with around $100 million in today's money. But what happened afterward? I lost nearly everything. Why? Because I became a stubborn contrarian when I should have been following the tape. After the initial crash, I remained bearish. I was convinced the worst wasn't over. And fundamentally, I was right. The economy was in shambles. But the market doesn't care about being right. It cares about making money. When the market began to rally in 1930, I fought it. I maintained short positions against the evidence the tape was showing me. I ignored my own cardinal rule: never argue with the tape. The price action is telling you something, whether you understand it or not. When I saw those rallies forming, I should have covered my shorts and reassessed. Instead, I dug in my heels. I convinced myself that I understood something the market didn't. This is a trap many traders fall into. You have a thesis about where the market is heading, and when the market moves against your thesis, you don't adapt. You double down. You fight the tape instead of reading it. You become married to your position rather than married to the truth of what's happening. I lost millions fighting those bear market rallies. Each time the market bounced, I added to my shorts, convinced the next leg down was imminent. Sometimes I was eventually proven right, but not before suffering enormous drawdowns that destroyed my capital and my confidence. The irony is that I had written the rules to avoid exactly this situation. In my own trading guidelines, I explicitly stated, don't be a hero. Don't have an ego. Always question yourself and your ability. Don't ever feel that you are very good. The second you do, you are dead. Yet, there I was, believing I was smarter than the market. My ego wouldn't let me admit I might be wrong, even temporarily. The market humbled me, as it always does to those who refuse to listen. When the tape is telling you something, listen. If you're short and the market starts rallying, don't fight it. Respect it. Cover your position, step aside, and wait for clarity. The market will give you another opportunity to re-enter when the time is right. Your job isn't to be right about where the market is heading. Your job is to make money. Sometimes that means admitting you're wrong and changing course. The most expensive words in trading are, I'll just hold on a little longer. I know I'm right. Remember, the market can remain irrational longer than you can remain solvent. I learned this the hard way, and it cost me a fortune. Don't repeat my mistake. Success is the most dangerous drug in trading. I've experienced this firsthand. The intoxicating high of being right, of watching millions flow into my accounts, of newspapers calling me the boy plunger and the great bear of Wall Street. But this success planted the seeds of my own destruction. My greatest enemy wasn't the market. It was the overconfidence that bloomed inside me after each victory. In 1929, I made $100 million shorting the market before the crash. $100 million. Can you imagine what that does to a man's psychology? I began to believe I was infallible. I started seeing patterns that weren't there, convinced I had some mystical connection to market movements. This is the psychological trap I want to warn you about. Success breeds a dangerous arrogance. When you're right about a major market move, your brain creates a false narrative. You don't acknowledge the role of luck. You don't recognize the confluence of factors that might never align again. Instead, you tell yourself, I saw what others couldn't see. I'm special. This is the beginning of the end. I remember sitting in my office at the Heckscher Building in 1930, surrounded by ticker tape machines, convinced I understood exactly what would happen next. The crash had made me famous, wealthy beyond imagination. But what did I do? I abandoned my own rules. I stopped cutting losses quickly. I held positions too long. I traded too large. Why? Because success had corrupted my discipline. Let me share something painful but true. I went bankrupt multiple times throughout my career. In 1915, 1922, 1934, and finally before I took my own life in 1940. Each time the pattern was the same. A period of tremendous success followed by catastrophic failure, all because I allowed success to make me overconfident. The human mind isn't designed for the markets. When we succeed, our brains flood with dopamine, creating a high that distorts judgment. We begin taking risks we would never have considered before. We leverage too heavily. We ignore contrary evidence. We dismiss risk management. We believe we're different from other traders. Here's my advice, born from my own tragic experience. After your biggest wins, become more cautious, not less. When everyone is calling you a genius, question yourself more rigorously. When your account reaches new highs, reduce your position size rather than increasing it. The market has a way of humbling those who believe they've mastered it. I developed a practice later in my career, though too late to save myself. After a significant win, I would force myself to trade at 50% of my normal size for at least 2 weeks. This prevented the overconfidence from immediately destroying me. I called it my success quarantine. It allowed the psychological intoxication to wear off before I made my next major decision. Remember this: in trading, success is often more dangerous than failure. Failure teaches caution and humility. Success teaches arrogance and recklessness. Guard against the psychological ruin that follows your greatest triumphs. This wisdom cost me everything to learn. The Phoenix strategy is what I developed after losing everything. Twice. Many know me for making millions short in the 1929 crash, but few understand the system I built to repeatedly rise from financial ashes. My comeback method isn't about revenge trading or doubling down on losses. It's a disciplined rebirth process I've refined through painful experience. When I lost my second fortune in 1915, I discovered something crucial. The market doesn't reward desperation. It rewards patience and precise timing. My Phoenix strategy begins with complete detachment from your previous losses. I force myself to view the market as if I have never traded before. Clean slate, fresh eyes. First, I enter a deliberate hibernation phase. After a significant loss, I step away completely, sometimes for weeks. During the cotton market disaster that nearly ruined me, I disappeared to Europe. This distance isn't weakness, it's strategic recalibration. Your emotional circuitry needs time to reset. I've watched countless traders fail because they immediately jumped back in, carrying psychological damage into new positions. Second, I rebuild from microscale. When I return, I trade at 10% of my normal size. This isn't about the money. It's about reestablishing execution discipline. I need clean, precise trades that follow my rules exactly. Each successful small trade rebuilds the neural pathways of discipline that big losses damaged. Third, and this separates winners from perpetual losers, I conduct a ruthless post-mortem. I document exactly what happened, without emotion or excuses. After my 1915 disaster, I filled 3 journals analyzing my mistakes, not to punish myself, but to extract the valuable lessons hidden in failure. Your losses contain the seeds of future millions if you're brave enough to study them objectively. Fourth, I identify one specific market inefficiency to exploit. After major losses, I don't scatter my focus across multiple strategies. I find one pattern, one edge, where I have absolute conviction. Following my cotton market debacle, I focused exclusively on pivot point breakouts and railroad stocks, nothing else. This concentrated focus accelerated my comeback. Finally, I implement position scaling with mathematical precision. I start with minimum size, then increase position size only after hitting predetermined profit milestones. When rebuilding my fortune in 1916, I wouldn't increase position size until I'd made 10 consecutive profitable trades at my current level. This prevented premature scaling that could trigger another wipeout. The Phoenix strategy isn't about getting even with the market. It's about emerging as a more formidable trader. After each catastrophic loss, I returned stronger because I transformed the experience into strategic advantage. The market took my money, but it gave me something more valuable: wisdom. I couldn't have acquired any other way. Remember this: your greatest trading education comes from devastating losses, but only if you survive them. The Phoenix strategy ensures you not only survive, but emerge more dangerous than before. My fatal flaws nearly destroyed me multiple times. Yet these same weaknesses, once recognized and harnessed, became the foundation of my greatest trading fortunes. This transformation from liability to asset is perhaps the most valuable legacy I can share with you. I've lost 4 fortunes in my lifetime. 4. Each collapse brought me to my knees, and twice to the brink of suicide. The pattern was always the same: spectacular success followed by catastrophic failure. Why? Because I refused to acknowledge my psychological blind spots. My primary weakness was always overconfidence after a winning streak. In 1907, I made $3 million shorting the panic, equivalent to $90 million today. I felt invincible. By 1908, I'd lost it all because I started believing I could never be wrong. The market quickly corrected that delusion. Here's what I learned. Success is more dangerous than failure. After failures, I became cautious, methodical, and disciplined. After successes, I became reckless, emotional, and arrogant. This pattern repeated for decades until I finally understood the lesson. I turned this fatal flaw into fortune by implementing a strict system of rules that protected me from myself. When I felt most confident, that's when I reduced my position sizes. When I felt the urge to break my own rules, that's when I stepped away from the market entirely. I learned to treat my emotional state as a contrary indicator. My second fatal flaw was isolation. I traded alone, trusted no one, and kept my methods secret. This made me vulnerable to my own blind spots. No one was there to question my logic when I veered into dangerous territory. After my third bankruptcy, I began sharing my thoughts with select colleagues, not for their approval, but to verbalize my reasoning and catch inconsistencies in my thinking. The transformation came when I realized these weaknesses weren't unique to me. They were universal human tendencies. The very emotions that destroyed me, greed, fear, pride, and impatience, affect every trader. The difference is that I learned to recognize and weaponize them. When I felt greedy, I knew the market was approaching a top. When I felt fearful, a bottom was likely near. My emotions became my market barometer, but only once I stopped being controlled by them. My third fatal flaw was my inability to sit tight. As I wrote in my memoirs, it never was my thinking that made the big money for me. It was always my sitting. Yet sitting tight through the fluctuations was the hardest discipline to master. I would take profits too early or cut losses too late. I conquered this by implementing a mechanical rule. Once I identified a major market move, I would commit a portion of capital that I wouldn't touch until my price target was reached. No matter what newspapers said, no matter what rumors circulated, no matter how I felt. This simple rule generated millions in profits during the 1929 crash, when I held my shorts despite violent counter rallies. Your fatal flaws, the very things that have cost you money in the market, can become your greatest assets if you recognize them, respect them, and build systems to harness them. The market will teach you about yourself more honestly than any mirror ever could. Listen to those lessons.